Let's talk about 4 companies that are oversold or at least cheaper than before. Oversold meaning on a technical basis, and then cheaper than before meaning on a 5-year mean, even on a 1-year mean. Valuation wise, forward PE, price to free cash flow, all of that is much lower right now. It can be because the stock has crashed a lot in recent weeks, or fundamentally the business has become better, the stock has not followed. Now, stock number 1 is a dividend paying one, and it's one that you probably know already quite well, and that's Starbucks. Starbucks in recent weeks, actually in recent months, have been getting hit quarter after quarter, month after month, and more recently, the recent earnings report was really not a good one. Stock is getting punished quite hard. But in my opinion, Starbucks is still one of the most recognized brands in the world. Every country you go, every time you go on holiday vacation, you're probably going to see a Starbucks cafe there. Whether you like the coffee or not, I don't really think people rush to a Starbucks just for their coffees. At least that's my opinion. Now, let's go over a couple of numbers for Starbucks. So these were the highlight numbers for last quarter. Q2 non-GAAP EPS 68 cents, missed the estimates by 12 cents. Revenue came in at $8.56 billion, down 1.8% year over year. That missed estimates by $600 million. If you look at the comp, globally down 4%, North America down 3%, United States down 3% as well. Internationally, it's down 6%, but China, huge market for them, down 11%. With regards to guidance, comp growth globally, low single-digit decline to flat, US the same thing. As for China, single-digit decline. As for global revenue, low single digits, operating margin flat, capex around $3 billion, full-year EPS GAAP flat to low single digits, non-GAAP flat to low single digits as well. With regards to new store growth, globally around 6%, US around 4%, China 12%. Now, Howard Schultz came out with a couple of comments. He's basically the Bob Iger of today, but for Starbucks, but he still didn't rejoin the company right now. So he said, the stores require a maniacal focus on the customer experience through the eyes of a merchant. I'm confident the China business will return to health and become the company's largest market. Now, what's interesting here is that, of course, there is the focus on North America, on China. But if you look at this, they opened their 400th store in India, their 600th store in Indonesia, and their 1,900th store in Korea. They're on track to operate 1,000 stores in India by 2028, translating to one new store opening every 3 days. Again, don't sleep on growth of India as a country, as an economic superpower. And so if we look at the stock, of course, by the time you're watching this video, maybe the stock price might have changed by 1% or 2%, but overall, everything else still stands. Dividend yield right now sits at over 3%, which has been, I think, the highest since a long time ago. Year to date, the stock is down around 23-24% or so. Shareholder yield sits at 5%. Why is that? Well, because you got the dividend yield at over 3% and then the buyback yield at over 2%. In the last 10 years, annualized growth for the dividend is at 16.3%. In the last 3 years, 8.37%. So yes, you're buying here a company that, although the stock hasn't moved much, dividend payouts have increased throughout the years. Then, if we look at the valuation metrics, PE, forward PE, EV to EBITDA, price to sales, all much lower than the 5-year mean, trading now at 19.1 times forward PE, 13.6 times EV to EBITDA, 2.1 times price to sales. Price to free cash flow sits at 20.9, and then price earnings to growth at 1.49. If we currently look at the average analyst price target, despite everything that's been happening, still sits at $90, representing around 24% upside from the price we're at today. As you can see, the analyst estimates for fiscal year 2024 grow top and bottom line around 2.5% or so, but then a reacceleration in fiscal 2025 and fiscal year 2026. So if we look at Starbucks right now, the stock today, the stock rebounded a little bit. As you can see, extremely oversold. This is on the daily, huge gap down here because of the earnings report. If we zoom out, we can see that the stock has gone back to levels not seen since June of 2022, May of 2022. Could be the same rebound action from those prices. So what do you think? Are you a buyer of Starbucks? Are you a holder of Starbucks? You're sitting on the sidelines right now. Let me know down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. Really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now or go to fool.com/couchinvestor. Thank you very much. Moving on to stock number 2 is a stock that also got hit pretty hard more recently because of weak-ish earnings, and that's Expedia. Expedia, as you can see right now, stock is at around $111, $112. RSI is oversold. Now here also it sits at a spot it has been before, back in November 2023, where there the stock has gapped up after earnings. Could it be a support for right now? Let's wait and see. But let's have a look now at the business numbers. If we quickly look at the valuation metrics, we can see that right now forward PE sits at 9.1 times, EV to sales 1.2 times. The average analyst price target sits at $149, representing 34% upside from the price we're at today. Year to date, the stock is down around 26%. And as you can see, the analyst estimate EPS growth year over year is around 20% for the next coming fiscal years. Sales growth of around 6 to 7% or so. And as you can see, it is much cheaper than its 5-year mean on all metrics, besides the price to free cash flow that sits at 9.1 times. This is also a last 12-month metric here. Price earnings to growth sits at 0.45. Yes, extremely low, but it has been quite low for quite a while. Now, why is price to free cash flow a bit higher? Well, in Q3 and in Q4, free cash flow did take a hit. So what exactly has happened? Where was the weakness? So they said here our first quarter results met our guidance with revenue and earnings beat, but with less robust gross bookings. We saw continued momentum in B2B, brand Expedia, and advertising. However, Vrbo's recovery following the recent replatforming has been slower than anticipated, which has put pressure on gross bookings. As we enter the second quarter, we are seeing some acceleration in the rest of our B2C's business and expect it to continue throughout the year. But given the Vrbo drag and the rate of acceleration in B2C thus far, we are lowering our full year guidance to a range of mid to high single digit top line growth with margins relatively in line versus last year. Of course, the market was not quite happy with those comments, especially not since the bookings numbers were quite good. Also, by the way, we're going to cover Airbnb's numbers. I do expect them to be, again, quite good. And so if you want to pause the screen, you can look at all the metrics for the quarter. So booked room nights is up 7% year over year. Gross booking only up 3% year over year. Revenue up 8%. But operating loss down 9%. Net loss attributable to Expedia Group down 7%. Adjusted EBITDA up 38%. Free cash flow down 8% as well here. By the way, this company is buying back quite a lot of shares. I believe their share buyback program, it allows them to buy around 25% of the company right now. So, I mean, if you're looking for great shareholder returns other than the stock, I mean, I do expect this company to recover. So you as a long-term shareholder seeing all of those buybacks will definitely benefit from that recovery. But of course, I understand those that go with Airbnb. I went with Airbnb, and those that went with Booking as well. Tremendous companies. But if you're looking for, let's say, value, cheap value, in my opinion, Expedia is one to look at. Now, the next company I want to cover is the first time we're covering this company. And although this one is not oversold, it is cheaper than before. And I do still think that we're going to see quite a nice recovery with regards to its stock and its business, and that's Zoetis. So Zoetis right now is at $164.5 or so. As you can see, it was oversold back in late April, but we have seen a recovery since then. Good earnings as well, so the stock pumped up. For those also that don't know, Zoetis is the largest global animal health company committed to nurturing the world and humankind by advancing care for animals. Now let's dive a little bit deeper. So currently the average analyst price target sits at around $210.99, representing close to 28% upside from the price we're at today. Year to date, stock is down 16%. If you look at valuation, forward PE 28.1 times, EV to sales 8.6 times. If you look at what the analysts are expecting for this company in the coming fiscal years, yes, you might not see huge growth there, but it is solid growth year after year. If we look at some valuation metrics compared to its 5-year mean, you can see that on all metrics, it is cheaper than before. That's what you get when you get a hit in the stock, plus you see some positive reacceleration in the business. That's just a great mix. You could also say that in the past, maybe this company was overvalued, could also be, but right now it is cheaper than before. Plus you have some positive momentum with regards to its business. And then again, if you like this type of industry, it is one of the stronger companies. As for the latest quarter, revenue increased 10%, net income increased 9%, adjusted net income 4%, diluted earnings per share increased 10% as well. If we look at guidance for the full year, revenue has been updated, EPS has been updated as well, actually maybe even raised. So revenue to come in at $9.05 to $9.2 billion, operational growth of around 8.5 to 10.5%, reported diluted EPS coming between $5.34 to $5.54. And in the past 10 years, shares outstanding have come down by around 9%. Free cash flow per share has gone up by quite a lot. So yes, you're buying here definitely a pretty strong company. Moving on to company number 4, last one for this video, and that's a company that's also oversold. It's a company I personally own. It's a company where you just need patience, but if it works out, I do think that long-term shareholders will be rewarded quite handsomely, and that's the only Intel. Intel is now back under $30. As you can see, RSI here heavily oversold on the daily. Now we're back to prices not seen since June of 2023. Of course, here as well, you got a gap down after the earnings report, which we covered on the channel. So Intel right now, although you can see that EV to EBITDA, price to sales next 12 months is not cheaper than its 5-year mean, it is oversold. And I mean, if you've been following the company or if you've been following this channel, you know why these metrics are higher than before. They're investing heavily in foundry. They're investing heavily in their future. Now is basically the time where they are looking at profitability, at margins, but we have to look a bit forward in the next coming years, especially in 2030. But of course, 2030 is 6 years away. You already want to see some results at least towards the back half of this year, plus starting next year as well. I do think that we're going to see a lot of metrics improve because the heaviest investments have already been made. And so you're going to see, in my opinion, unless the stock explodes, which I highly doubt it will happen anytime soon, but you're going to see PE, EV to EBITDA come down quite a lot. If we currently look at the average analyst price target, sits at $41.26, representing over 38% upside from the price we're at today. If you look at the analyst estimates, fiscal year 2024, very, very slow growth, top line 3.3%, EPS only 5.24%, but then a huge reacceleration top and bottom line for the next 2 fiscal years and probably onwards as well. If we look at their last earnings report, the report came in line, but then again, outlook is a bit weak-ish. Revenue to come between $12.5 to $13.5 billion. Gross margin non-GAAP 43.5%. EPS non-GAAP of 10 cents. Market was expecting a bit more. Again, for the quarter, good client computing segment that came in. We saw the same a bit with AMD. Data center still quite weakish. And then all the rest, network and edge, Intel Foundry, still quite small right now. Altera, Mobileye, all down year over year. But I'll repeat it again and again. With regards to Intel, it's all about execution. It's all about proving the market wrong. It's all about proving that their investments are worth it. And in my opinion, Intel still being one of the most important semiconductor companies in the world, the one that is making moves towards diversification of the supply chain, of the countries that provide chips to every other company. Yes, their bet now on their foundry business is a big one. In my opinion, it's going to work because, well, the government needs it to work as well. You don't want to rely solely on what happens in Taiwan. You want to diversify that a little bit. That's also why they get funding by the government. Of course, it creates jobs. So it's the logical thing to do right now. But then again, execution is key. Talk is cheap. We want to see results. Probably towards the back half of this year, I do expect to see some meaningful results with regards to revenue reacceleration, profits as well. With regards to positive effects with the foundry business, I think that's still going to take a while. We have seen already a couple of partnerships, some clients there, but I do think that the results for the foundry business are still a couple of years ahead of us. So that's about it for this video. Those are the 4 stocks I'm going to talk about right now. Of course, there are plenty of other stocks that are probably oversold right now, but can't cover all of them. But do let me know down in the comment section below which company you would like to see in the future videos. Let me know down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.